All right, team, welcome back. You've been doing amazing work, just crushing it with US GAAP. And you know what? We're at the final hurdle for this section. It's time to tackle the key differences with IFRS. Now, I know this is a topic that can trip a lot of students up, but don't you worry. We're going to make this crystal clear so you can walk into that exam feeling totally confident.
Seriously, I know how many hours you've put in mastering the US rules, and that is fantastic work. But remember, the CMA is a global certification. That means we have to look at the international standards. It's just a crucial piece of the puzzle. But I promise you, we're going to break this all down and make it super simple and clear.
Okay, so let's dive right in with the single most important concept you need to grasp. Just think of it this way. US GAAP is like a super strict, really detailed rulebook, right? It tells you exactly what to do in pretty much every situation. IFRS, on the other hand, it's more like a set of guiding principles. It gives you the framework and then kind of trusts you, the professional, to apply it correctly. And honestly, this one idea explains almost all the differences we're about to cover.
Now, let me just say, don't worry. You do not need to become an IFRS expert overnight. That's not the goal. For the CMA exam, what you really need to know are the key clashes. The specific places where these two standards really butt heads. So we're going to focus only on the 4 areas that I see pop up most often on the exam. Let's really dial in on those.
First up, we've got the heavyweight champion of GAAP versus IFRS questions. And I'm not kidding here. If you remember only one single thing from this entire explainer, please make it this. We're talking about inventory and specifically the LIFO method.
That's it. That's the whole rule right there. Under IFRS, you absolutely cannot use the last in, first out inventory method. It is completely banned, prohibited. This is probably the single most frequently tested difference between the two, so please burn this into your memory.
So, just to spell it out a little more, as you already know, US GAAP is pretty flexible here and lets you use LIFO, FIFO, or average cost. But IFRS, it puts its foot down and says no way to LIFO. And if you're wondering why, well, the thinking is that LIFO can leave a really stale or outdated inventory value on the balance sheet, a value that, often doesn't reflect how goods are actually moving.
Okay, and there's just one more little inventory point to remember. Under US GAAP, if you write down the value of your inventory, you can never ever write it back up. It's a total one-way street. IFRS, on the other hand, is, you guessed it, more flexible. If the value of that inventory recovers, IFRS actually allows you to reverse that previous write-down. See the pattern here? All right, let's move on to our second key clash. This one is all about how we value our long-term assets. Our property, plant, and equipment, or PP&E. And yep, this is another one of those classic rules versus principles battles. You can really see the conservative nature of US GAAP here. It sticks strictly to what's called the cost model. So you report your building at its historical cost minus depreciation, and you can never, ever write it up in value. But IFRS, staying true to its principles-based nature, offers a choice. It allows something called the revaluation model. And this lets a company revalue an asset up to its current fair market value, with that increase usually going into other comprehensive income.
And hey, one more quick point on assets. IFRS gets a little more granular here. It actually requires what's called component depreciation. The best example is an airplane. IFRS says you have to depreciate the engine, the seats, and the body of the plane all separately, right? Because they all have different useful lives. Now, US GAAP allows this, but it doesn't force you to do it.
We are in the home stretch now. Let's knock out the last 2 key areas with a couple of quick hits. Now, these are just as important for the exam, so let's keep that focus laser sharp.
First up, let's talk about asset impairment. US GAAP, true to form, has a more complex 2-step test. First, you have to check if an asset is impaired, and only then do you measure the loss. IFRS, it just simplifies the whole thing with a 1-step test. You just compare the asset's book value directly to its recoverable amount. So much more direct, right? And hey, just like we saw with inventory write-downs, it's the same story here. US GAAP says once an impairment loss is recorded, it can never be reversed. It's done. But under IFRS, what do you think? If the asset's value bounces back, you can absolutely reverse that impairment loss. Again, it's all about that flexibility to reflect current economic conditions. Okay, next up is R&D, and I know this one can be a common point of confusion, so let's clear it up. US GAAP keeps it really simple and conservative. All research and development costs, they're expensed immediately, gone. IFRS, however, is a bit more nuanced. It splits R&D into 2 phases. The research phase costs are expensed, just like GAAP,
But once a project becomes technically and commercially viable, those development phase costs can actually be capitalized as an asset. It's a huge difference.
And for our last quick hit, contingent liabilities. So to record a potential loss under US GAAP, the event has to be probable. And that is a really high bar. We're talking like 75 or 80% likely. IFRS uses a much lower threshold, more likely than not, which simply means over 50%. So what's the result of that? Well, it means liabilities often get recorded much sooner on the books under IFRS.
Okay, wow, that was a lot of information, but you did great hanging in there. We've officially covered the 4 major clashes you absolutely need to know for the exam. So now, let's put it all together in one simple table that you can use for your final review. This is your exam game plan, right here.
Let's just quickly recap these key clashes. LIFO. GAAP allows it. IFRS prohibits it. Revaluing assets. GAAP says not allowed. IFRS says it is. How about reversing impairments? GAAP says no way. IFRS says yes, you can. And finally, R&D. GAAP expenses everything, while IFRS lets you capitalize those development costs. I mean, the pattern is crystal clear, right? IFRS consistently offers more flexibility. So here's my final tip for you, my little secret weapon. If you are ever stuck on a GAAP versus IFRS question on the exam, I want you to just take a deep breath and ask yourself 2 simple questions. First, which answer here feels more flexible and allows for more professional judgment? That's almost always going to be IFRS. Then ask, which answer feels more rigid, more conservative, more rule-based? Well, that's your US GAAP answer. It's a fantastic mental shortcut that really works.
And that's it. We've done it. We have covered the entire landscape of key differences you need for this part of the exam. You are so ready for this. Now, to really make sure all this knowledge sticks, how about we lock it in with a quick 10-question comprehensive review quiz? What do you say? Let me know. You've totally got this.